Good morning, good morning, good morning. It is Monday, the 23rd of February. This is the Morning Blast, where myself, Ryan, and of course Michael give a very candid market podcast. What is been going on as it's Monday, what's been going on over the weekend, what's going on today. Also, a brief look at the week ahead. Usual caveats, nothing said on the podcast is trading or investing advice. We do not apologize for the what's the word for it? I don't think I don't think there is a word for how you would describe the podcast, but basically we don't pull our punches. There's no editing goes involved. You take us as you find us. Far side rather than fireside. There you go. Michael, how are you? Good weekend?
Yeah, very good morning to Ryan. Good morning, everyone. The weekend was all right. The less said about the rugby, the better, but a good result in the football. Arsenal's title challenge is back on.
It's still alive. It's still alive.
Indeed. And yeah, if you believe what the people on the internet are saying this morning, we're on the verge of World War III. AI is about to take everyone's job, and the tariff ruling is the worst thing to ever happen in the history of the world.
Yeah. Just briefly on the
I've got the hump.
Just briefly on the AI's taking over the world kind of thing. That's it. This all stems from Citrini, who is actually a friend of mine. I've met him a couple of times in London. I actually got him on gin and ginger beer. There you go. That's a little claim to fame for you.
Is that your contribution to
That's
this
my
debate?
contribution to life. It was me that got him on. Maybe this is the reason why he's put that article out. Maybe he's just drinking too much. But it's a very, very good article. And also, what people don't seem to understand is it's just a scenario, and it's actually a good. It's actually the piece is very, very good, and it's a good scenario. He's not saying that that's his base case. It's just like, look, this is one of the options that might happen. But people are reading that as two things. One, the world's ending, and oh my God, this is what AI is going to do. And also, this is Citrini's base case view, which neither of them are accurate. But there you go.
Again, it does make me chuckle that I would say there's quite a good overlap between the same people who are reading that saying that, the world's going to end, are also the people who probably about 3 weeks ago were saying that, everyone's spending too much on AI, CapEx is ridiculous, blah, blah, blah. You can't have both of those being true at the same time, guys.
No, exactly. And it's also the same people that are claiming the world's ending because of tariffs. And yeah, there's a whole Venn diagram that we could do, which is people just love getting a bit frothy knickers over the same things, the same times, and also with horrendous takes on the data available. But This is why people listen to us, to hopefully cut through this shit. Speaking of cutting through shit, let's get a market update from our good friend Clive Lambert at Futures Techs. Where do we start if he can even find it? Where's he put it, Ryan? Where's the thing? One sec.
Have you lost it?
I did.
I'm not sure you ever had it.
I clicked the. Well, I've always had it, mate. Right. Equity. This is obviously for Friday, and as Clive went to print this morning, market moves and levels to watch. Equities continue to post mixed signals depending on where you look. S&P held 68.45 once again on a dip on Friday, so that's bullish. Nasdaq is lagging slightly, though struggling to see off resistance at 25.045 or 0.45. DAX was bid on Friday, but is offered overnight so far. So obviously that's Sunday night. Eurostoxx 50 made a new all-time high on Friday, as did the FTSE. Same old story for those. Nothing to do with the Labour government, nothing to do with UK PLC. Bund futures, they closed above 129.32 on Friday, so that should encourage the bulls, even if the RSI has moved into overbought territory. In Forex markets, cable and Eurodollar both posted doji candles, the former holding its 200-day simple moving average. That's obviously seen as support now. Bitcoin offered so far this morning down to 64,250. Gold, the yellow metal, its bid since we last wrote. Resistance is now at 5,144. Silver currently above 84.74 Fibonacci level that we've been watching of late. So obviously if we're above that, that's now acting as support. Platinum and palladium also caught a bid on Friday, which retook some key levels. On the London Metals Exchange, copper, Dr. Copper is trying to get up, but 13,030 continues to be a point where we weigh. Nickel holding its Marabuzu support. 17,140. And aluminium is trying to move away from uptrend support at 3,036 this morning. Brent and WTI, the oil benchmarks, both posted doji candles. And remember, were those that are worried or not worried, those wondering, dojis are small bodies, long wicks, a bit like myself. Both posted dojis on Friday, and they've had a mixed and damp start to the week, a bit like myself. 72, 74 to 83 is the next strong resistance to gun for in Brent. Obviously, Middle East is still there this morning. It didn't blow up over the weekend, so slight bit of maybe a little bit of risk off play coming into that. We'll see how it goes. Also, just of note quickly, there was chatter, I saw some headlines over the weekend saying targeted strikes might be the answer, kind of thing like that. If it is targeted strikes, that goes against the kind of trend we saw towards the end of the week where it might be like, weeks long occupations and stuff. So therefore that would actually be, believe it or not, like we talk about, a hawkish cut for Fed, that would be a bearish military action on Iran for crude markets, considering how much crude rallied on the risk on the fact that we could be looking at a prolonged operations, etc. But there's a lot of moving parts. So let's not start trying to guess what's going to happen there. TTF gas, so Dutch European benchmark gas, gapped lower after posting a red candle on Friday. So watch 31.35 now as gap resistance. We love filling gaps. Wheat was green again. Obviously, US wheat was green again on Friday, getting up to 582. We now have Marabouzi support at 574, and that has held so far today. Soybeans, also over in the US, saw a deep dip to 1,121.4. That found buyers on Friday, so that's still pointing higher. Michael, so firstly, thank you, Clive. Michael, what's been going on the weekend?
Yeah, good stuff. Thank you, Ryan. Thank you, Clive. Well, fucking plenty of monkey business going on, to be honest with you. It's all annoying me. We'll do the tariff stuff in a second because we're going to dig into that in a bit more detail. But besides that, we may as well start with geopolitical developments. As Ryan rightly said, it does appear as if the narrative has moved, well, as of 8:30 Monday morning. It may all have changed by the time you listen to this. It appears that the discussion has moved away from kind of a full-scale conflict towards this idea of a potential limited targeted strike on Iran, which would then be accompanied with the threat of a larger attack if the Iranian leadership were not to arrange or negotiate or agree to a deal with the United States. Again, the situation is very, very fluid. It's very, very fast moving. The US continuing to amass a huge military presence in the region. And truthfully, no one apart from the commander in chief, which is, of course, President Trump, really knows how this is going to pan out. And I would also argue that probably even he hasn't made a final decision as to what he is going to do yet. The other thing, just to bear in mind in terms of the US-Iran situation, is that a further round of talks between the two sides is currently scheduled for Thursday in Geneva. Of course, one of the key things to keep an eye on as we move through this week will not only be the sources reporting around potential military action, but also confirmation that those talks are indeed going to go ahead, or if things collapse, confirmation that the talks are not going to go ahead. I think that's, in terms of concrete developments, that is the big one to keep an eye on as all of the rumor and bluster around potential military action continues. That is certainly going to be one of the main things that market participants keep on their radar throughout the next week. As for other developments besides the Supreme Court ruling on trade, which we'll get to in a second, we did have quite a data-heavy Friday in terms of the latest PMI figures, actually surprising to the upside of consensus expectations in both the Eurozone and here in the UK. Composite output in the Eurozone rising to a 3-month high 51.9 according to the flash February PMI. Here in the UK, we also saw an unexpected rise in overall economic output, with the composite PMI rising to 53.9, which is a 22-month high. And that was largely driven by an upside surprise in the manufacturing sector, where output increased in February at its fastest rate in 18 months. Of course, we did have a bit of a hat trick of positive economic surprises from the UK on Friday. We had that better than expected retail sales number. We had a record budget surplus and these PMIs. All of them come with a bit of an asterisk and a bit of a caveat, though, because because, of course, retail sales were largely underpinned by folk rushing out to buy gold and buy antiques. The public sector borrowing figures, that record surplus, was driven not only by... Oh, hello.
Sorry, hello. I was thinking about this Friday, maybe. This antiques thing, which was very, very weird. Okay. Is it at all possible that people buying old sovereigns and stuff like that is falling under antiques?
Yeah, well, I don't know exactly how the ONS classifies.
Sorry, for those that aren't aware, when I say sovereigns,
gold coins, basically.
Old gold coins, basically like that, rather than buying like. So yeah, because it just seems weird that people buy people aren't buying fucking Chippendale furniture, as in the old furniture maker, not the male strippers. But yeah, God, what would that furniture look like? Oh Jesus,
let's move
not a chair leg.
From that. Oh no!
Yeah, no. In my opinion, there's some kind of methodology cock up there for the antiques to be up so high. I wouldn't be a bit surprised if you look into the details, there's something regarding antique gold coins and sovereigns and stuff like that, which would make far more sense.
Surprise. It would not be a huge surprise, but I would also say that even if that isn't the case, and I think that is a plausible explanation, even if that isn't the case, it's still not a particularly great sign that people are going out and buying antiques.
Oh no, absolutely not.
And artwork, because they're the sort of things that people buy basically to try and store value. It's not as if they're buying them they might display them on the wall, but it's not a discretionary purchase.
Oh yeah. Sorry, I'm not suggesting it just makes it a good thing. I'm just trying to work out why kind of the numbers perked up for basically the first time I can ever remember.
Well, there you go. There's some homework for one of our listeners. If they fancy it,
it's a very nerdy bit of homework, so it sounds like something that Tom would do.
It does, doesn't it? Lovely. In terms of just to recap the other caveats around the UK data, obviously we discussed the retail sales numbers. The borrowing stats were underpinned by the usual surge in tax receipts that we see in January. But we also actually, when you dig into the numbers, I think capital gains tax receipts were up by something like 40% year on year, which is basically people selling assets in fear of higher tax rates going forwards, which again is not really something worth shouting about if we're being completely honest. And even in terms of those PMIs, while the headline numbers were strong, undoubtedly, if you again dig into the details, pointed to the economy losing jobs per the S&P global data for the 17th month in a row, which again is not really worth doing the victory lap that all of the Labour MPs have been doing over the weekend. We also had some data out of the US at the back end of last week. GDP, the economy grown by just 4% on an annualized quarter-on-quarter basis in the final 3 months of 2025. The vast majority of this, though, came due to two things. Firstly, the record-long government shutdown. Government spending actually fell by the most since 2020 in the final quarter of last year. And the second was a hotter-than-expected PCE deflator. Effectively, inflation hotter than expected means real growth was lower than expected. And actually, core PCE in December coming in at 3% on a year-on-year basis. That was up from the 2.8% that we saw in November. But that is relatively stale at this point, considering that we've had the January CPI numbers and we'll get the January PPI figures on Friday. Just two other things worth bearing in mind, just in terms of the tech sector. Google, or Alphabet, I should say, they're reportedly looking at ways to expand the market for the AI chips that they've been making, potentially of note for some of the chip makers like Nvidia and Broadcom. Of course, Nvidia reporting this week. And also in the AI space, Claude, or Anthropic, they released something called Claude Code Security on Friday. Apparently, this is available in a limited research preview. It did cause some downside in names like CrowdStrike and Okta. The reason I mention this is because it just kind of feeds into the broader narrative around, AI is going to kill every single bit of software that anyone's ever developed. And it seemed like internet security stocks were the ones in the firing line as the week drew to a close.
Sorry, just on that, this does tie in something. I'm sure we mentioned it. It was either last week or the week before, where we've been talking about like moats for these kind of companies and how there is a risk these days that one of the big AI names could say, oh, by the way, you can now do X, Y, or Z on our AI. And a great example of this, I believe it was Google with Gemini, one day said, look, well, we've already got all your search data and all of this stuff. Now you can actually book. One example of using Gemini is to book your holidays, because we'll literally do everything for you. And then straight away, booking.com are like, well, fuck. So, I mean, potentially one thing that, a skill out there for a stock picker is to work out what could be the next thing that, one of the, something like Gemini, which already has all your search data and, you're already using Google anyway. Most people are, regardless anyway. What thing could they just roll out very easily that really collapses the moat or like kind of fills in the moat that someone else was having for quite a significant amount of time? I think we said
Yeah.
before, like real estate companies like Rightmove and stuff like that, potentially, again, they must be thinking, God, any day now we could wake up and our moat's completely gone. I
Well,
think,
I mean, if you recall, Rightmove actually, was it Rightmove? They said something around an earnings report relatively recently. They said they were going to chuck a load of money into AI and the stock just fell off a cliff, which kind of speaks volumes about how the market is perceiving that one. Basically saying, fine, you can try and catch up yourselves, but you're probably not going to be able to do it.
and this is the thing, right? And I think this, again, there's a load of possible ways this plays out. Again, not predictions, just scenarios. I think it's very important to make that differentiation, especially this time. Yeah, I think it's really interesting to look at a lot of these companies and think, okay, well, I think we said before as well, it might be in the Friday Fix I mentioned it, where like things like Indeed, like the jobs boards and
Mm.
stuff like that. At the end of the day, they're just jobs boards. If Google could very easily, or someone like Google could actually very easily just kind of spin up their own version, and immediately, you're going to see that, Indeed share price take a hell of a hit, and like for like companies, etc. But interesting
Indeed.
time.
Should we do tariffs?
Yeah, go on. Yeah, so basically, for those of you that have been living under a rock, the SCOTUS decision finally came out last week. SCOTUS ruled 6-3 on Friday that the IEEPA does not give the president the authority to impose tariffs. Chief Justice Roberts wrote that the two words regulate and importation in the statute cannot bear such weight. Very getting all legally here. Trump responded within minutes, hours by signing an executive order imposing 10% global tariffs under Section 122 of the Trade Act. By Saturday, he had already bumped it up to 15%, the maximum allowed under the statute. The speed of the escalation from 10 to 15% tells you everything you need to know about the mood in the White House. He announced 10%. It got mocked as toothless, and within 18 hours, he'd maxed it out to the legal limit. Trump called the decision deeply disappointing, and said he was ashamed of certain justices, calling them very unpatriotic and disloyal to the Constitution. He even went after Gorsuch and Barrett and the two justices he nominated who voted against him, saying, I think it's an embarrassment to their families. Although he did praise Thomas, Alito, and Kavanaugh, the three dissenters, for their strength and wisdom and love of our country. So, yeah, Michael, give us your thoughts.
Yeah, well, I mean, I think there's two distinct things going on here. One is President Trump realizing that the judiciary is not just there to do his bidding, no matter who appointed them. And the second is the trade story and tariffs and where we go next. Given that I'm not a lawyer and given that this is a market podcast, I think we should probably stick to the second one for the time being. And actually, I'm relatively pleased because effectively, what's happened is what we said would happen if the IEEPA tariffs were struck down. Namely, that, not a lot changes in the grand scheme of things. All that's happening really, in the way that I would be framing this, is that the legal means through which tariffs are being implemented have changed. They are not now implemented under one statute of US commerce law. They are being implemented under another. The ends, i.e. the overall tariff rate on average staying at about 15% or a rounding error away from that, have not changed, and they are unlikely to change. And I think ultimately this is slowly but surely dawning on market participants that, yes, there's been a lot of legal hullabaloo and there's been a lot of hysteria and very emotional language being used on both sides of the political aisle in the United States. But fundamentally, here and now, are we, or even in 2 or 3 days' time, are we going to be in a fundamentally different trading environment to where we were, a week ago, 2 weeks ago, a month ago? Ultimately, no, not really. Certainly not from a macroeconomic perspective when you're trying to game out the implications for GDP growth or for inflation or unemployment, I don't think any of those variables are likely to change at all based on the ruling that was handed down on Friday. The two kind of obvious, or the one sort of obvious implication is that there is now going to be a little bit more uncertainty on the trade front, at least in the short term, because although this 15% global tariff has been imposed for the next 150 days, the question is what comes after those 150 days. And I think there's probably two or three things that could happen there. Either the Trump administration sort of let it lapse for a day and then bring it back in for another 150 days, and that would open themselves up to quite a lot of legal challenges, or they go to Congress and ask Congress to approve an extension to that time period, which Congress might not be minded to do given the current environment. Or the third scenario, which I think is probably the most likely, is that these Section 301 investigations, which have begun into basically every country in the world, are going to have reported back by the end of those 150 days. So trade investigators and trade lawyers are going to be very, very busy over the next 3 or 4 months. And I would imagine, this is sort of my working assumption at this point, is that what ultimately happens is we end up probably 5-6 months down the line in the summer with a tariff structure that broadly resembles what we had under the IEEPA, just using other bits of commerce law. And I don't think that there's really anything for markets to price off the back of that. The one risk to this is what other countries do. Now, the best thing here is basically to do what the UK has done. And, it's rare that I would praise the UK government, but they've basically sat there and gone, we would expect that our privileged trading position with the US continues and we'll see what happens. The worst thing for anyone to do would be to start throwing around the threat of retaliation or tariffs of their own or some sort of other measures to, quote unquote, get back at the United States, because firstly, nothing has really changed. Secondly, for the majority of countries where tariff rates have changed, they've actually changed in favor of that country. China's gone from 20% to 15% or 30% to 15%. Brazil has had a fair chunk lower. India is a fair chunk lower. Europe's the same. Japan's the same. South Korea's the same. Actually, I think it's only the UK and Australia that have got off worse here. And both of those are just kind of sitting back and waiting and see what happens. So as long as that remains the case, as long as changes to the overall average tariff rate remain minimal, I really don't see this as a game changer from a market or a macroeconomic perspective, to be honest with you.
Yeah, no, I completely agree. Again, it's that Venn diagram of people losing their minds over it. The same people that lose their minds over a blog post, same people that are claiming that it's World War III out there. Yeah, absolutely. I think you've hit the nail on the head there. Thank you very much. Hopefully we've given a bit of insight this morning into people that are worried or wondering and worried what's going on with these tariffs, etc. Michael, what have we got for the rest of the day? And also, as it's Monday, the rest of the week.
Yeah, well, to be honest with you, not a lot. The data docket this week is about as empty as it has been really for any week of the year so far, to be completely honest with you. Although, of course, participants will continue to monitor very closely indeed ongoing trade headlines, as we just discussed, but please don't overreact to those. And also the geopolitical situation in the Middle East, chiefly those talks between the US and Iran, which are due to take place on Thursday in Geneva. Besides that, in terms of today, we do get the latest IFO sentiment surveys out of Germany at the top of the hour in about 5 minutes' time. And then this afternoon, we get factory orders data from the United States. But this factory orders report is for December. So it is very, very stale at this point as they continue to catch up from the government shutdown. In terms of the rest of the week, as I said, the data docket is really lacking anything of any interest, to be completely honest with you. We get US consumer confidence tomorrow. We've got CPI from Australia on Wednesday, the weekly jobless claim stats from the States on Thursday. And then we also get, as I said earlier, PPI from the US on Friday. Frankly, I really struggle to see any of that materially moving the needle from a financial markets perspective. Certainly wouldn't imagine any of that having a material impact on the Fed policy outlook. Speaking of that, we do have plenty of Fed speakers throughout the week. Perhaps the most noteworthy will be remarks from Governor Waller. He speaks around lunchtime today on the economic outlook, and then a handful of Fed speakers follow him throughout the week. We're also due to hear from a whole host of Bank of England policymakers. They are testifying to the Treasury Select Committee God. They are testifying to the Treasury Select Committee tomorrow afternoon. Of course, that comes as markets price about an 85% chance that the MPC deliver a 25 basis point cut at the next meeting in March. Other than that, we do get a fair bit of Treasury supply this week, including 2, 5 and 7 year auctions on Tuesday, Wednesday and Thursday, respectively. And on the corporate earnings front, the pace of earnings does slow. I think we're probably through the vast majority of earnings season now, but we do have Nvidia reporting on Wednesday evening. Of course, sort of general enthusiasm around the AI theme has waned fairly significantly of late. And given that Nvidia is the biggest stock in both the S&P and the Nasdaq, that report will be watched very, very closely, not only for those trading Nvidia, but also as a bellwether for sentiment around the sector more broadly. One thing I would flag, though, is I was looking at options this morning. Options on Nvidia imply a move of about 4.5% in the stock in the after-market session on Wednesday. Sounds like a lot, and for a stock with a market cap of almost $5 trillion, it is a lot. However, for Nvidia, it's not, because that's actually the smallest implied move that options have priced for Nvidia since the May 2023 report.
Do you know what? I'm frustrated with myself there, because when you said 4%, I nearly interrupted you and went, "Is that all?" Because it seems, which again, then I didn't, because I was like, right, getting back in your lane, because in the scheme of things, 4% on a company that big is still massive. But we've had some much bigger options pricing around earnings for companies, and it just shows how mad things are, right? I think we saw like Microsoft. I think was it the last earnings report or one recently? It was like they were pricing 10% moves and stuff like that. It was all a bit balmy. But
so 4% is a lot. Don't get us wrong. In a stock with a $5 trillion market cap or whatever it is, it's humongous. However, for Nvidia specifically, it's not actually that much.
Well, but it feels like only yesterday we were talking about Nvidia being the first $1 trillion company, and now it's a $5 trillion company.
Oh no, it's crazy, isn't it? But yeah, other than that, we do get earnings from Home Depot and also CoreWeave this week. But once the Nvidia report is out the way, I think folk will basically claim that earnings season is over. And yeah, that's pretty much it in terms of the week ahead.
Yeah, I do think it'll be an interesting one to keep. I do putting a bit of a nerdy hat on here. I do think the CoreWeave one might be quite interesting, especially their commentary afterwards, bearing in mind what we're seeing with SaaS platforms and like. So that probably would be of interest for kind of a guide of where SaaS companies are looking to be going, especially like the security companies and whatnot. But yeah, no, absolutely. Michael, thank you so much as always. Listeners, I hope you had a great weekend. Hope we've added a bit of value and put a smile on your face this morning. Whatever you're doing today and this week, keep it tight, stay safe, be profitable, and hope